Yeah, well, got to lick some wounds. It's been a rough first half for those willing to take risks. Gunjan, thank you.
Thank you.
Let's take a closer look at the first half of the year for tech so far. Are investors right now in the danger zone? Our next guest thinks, though, comparing them to Top Gun's Pete Maverick Mitchell, saying they've been ambushed in enemy territory with a lot more pain lying in wait. Joining us this morning, Neuberger, Berman, CIO of Global Research Strategies, Hari Ramanan. Hari, I like this. I kind of like this metaphor because we're in an area you think where tech operators are having to operate in a different kind of equipment, where the dials are different and the plane just doesn't go as fast.
Yeah, hi, good morning. So, yeah, I think we think of the elephant in the room actually being the capital cycle that's playing out in tech broadly. And I think one of your other guests, as well as a friend of the show, Jim Chanos, has talked about that in the context of even his call on data centers. But the real sort of issue, we think, is the fact that over the last handful of years, you've seen a significant inflow of capital that's come in, even into private companies. I mean, the last sort of decade, we've seen approximately $200 billion or so per year of venture capital funding of private companies. That is now, over the last few years, has been up to $600 billion. And it's just now mean reverting to something like $200 or $250 billion. And I think that's a good and a healthy thing that is taking place. Now, that's actually true of many, many other parts of the tech space, too, including in software, including in the internet space, including in big tech, where you've seen the capital intensity of these companies that have been so-called or historically known for being capital-light businesses grow. So as the capital looks to generate a return, and sometimes those returns are going to be lower than what they would have provisioned for or assumed, that is going to lead to some recalibration in investors. And so we think what is happening is sort of both healthy, but it's not quite a bubble. People think about sort of history doesn't repeat itself. We think history does rhyme. So it's not quite a bubble of the 1999, 2000 types, but these are real companies. But they're going through an old-fashioned version of having thrown too much capital on the back of extrapolating certain trends that might be a little slower to play out.
Right. So as a result, you're looking at for names where they've been through cycles before, right? There is some wartime experience, and they're focused more on shareholder returns than chasing addressable markets or new customer acquisitions. What sort of tickers does that take you to?
Yeah, so maybe before that, when I think about sort of our playbook, I think you were right to, you talked about sort of swingers and doubling down. I tend to think of life in the form of Pete Mitchell or Captain Pete Mitchell facing this predicament where he's been flying F-18s for a decade, doing sort of cartwheels and loops and dogfights and coming out like heroes, except now they're ambushed, and what they have to do is go and find an F-14, dust it off, really jumpstart it, and sort of fly back to safety. So what that sort of implies for us is that there is equipment out there. There are things to do in this space. It may not be in the same sort of dashboard, or the dials are going to look different. In an F-14, it's going to be a slower plane. The amount of Gs you can put on are going to be lower. So I think we are finding opportunities in cyclical spaces. We're finding opportunities where there's headline risk. We're finding opportunities where there's idiosyncratic place to be had, as well as being opportunistic, but very selective as it relates to the more heavily trafficked software space. So when we look at sort of opportunities, we like the industrial economy. And so inside tech, there's companies like Analog Devices, which have been very careful about expanding capacity. Yeah. I realize that there's a recession call out there, and so people are generally nervous about semis. We're not that nervous because semis have been really battle-tested. And if you pick your spots inside semis, it's going to be quite a good place to be on the other side of what may be a mild, moderate, or a severe recession. So in other words, a recession doesn't scare us, a capital cycle does.